to the Inspire Wealth podcast with Prof M, where we dive into the world of real estate investing and wealth building strategies. I'm your host, Mallory Meehan. I'm a real estate professor, attorney, and seasoned investor here to guide you through the ins and outs of creating wealth through real estate. If you're looking to take your real estate knowledge to the next level, don't forget to subscribe to stay up to date with our latest episodes and offerings. Welcome to another episode of Inspire Wealth. I am your host, Prof M, aka Mallory Meehan, and today I am really excited to be bringing Fernando Angelucci to the stage. And Fernando, how are you today?
I'm doing well, Mallory. Thanks for having me.
Okay, Fernando, I know we just got done talking a little bit beforehand, but why don't you tell us a little bit about yourself, what aspect of real estate you're in, and then I'm going to start diving in and digging through your specific niche of real estate.
Okay. I'm a self-storage syndicator and a sponsor. We do self-storage development as well. In the last 6.5 years, I've done 56 transactions across 24 states, about $260 million worth of self-storage. We have a little over 820 investors, and it's been a great life over these last 6 years. It hasn't always been this way. I had to shift real estate assets a few times to finally find the one that I liked. So
I'm curious. Take me back 6 years and tell me what your strategy was and then how you pivoted to get into self-storage.
yeah. So when I graduated as an engineer, I basically didn't last at all. Very quickly, I realized that I was very bad at having a boss. So went into flipping houses, contract assignments on houses, rental properties. That very quickly, started stair stepping up to having multifamily apartment buildings and, larger kind of commercial apartments. Then very quickly, I realized that this supposedly very passive asset class is not passive at all. And tenants are nightmares and dealing with trash and all this other stuff. So what I realized was a lot of my pain was coming from the three T's, right? Toilets, tenants, trash. That was where most of my problems were coming from. But how do you do real estate if you don't have tenants, right? So then I started going out and doing research, and I found that self-storage was basically the answer to all of the problems that I had. So no tenants, state laws are written in the owner's favor. Everything is based off of auction law, so lien law, as opposed to tenant landlord law. Much easier to manage. So from a dollar's perspective, the assets, the amount of manpower needed to run it and control it, much less, but it still produces the same levels of rent per foot that you can get running an apartment building or, a single family house community. So then I decided to say, hey, let's go into this new asset class. But like I do every time I switch into a new asset class, I want to test the market first and reduce my risk. So I first started off by being a wholesaler for self-storage, which means I put properties under contract. I put up the earnest money, I do all the due diligence, and then I sell my contract rights off to somebody else so they can close on the property, but they have to pay me a fee, obviously, for me to release those rights to them. So what I realized is over the 2 years between 2016 and 2018, I had some veteran self-storage operators, 20, 30 years in the business, buying deals from us at a higher price than we were putting them under contract, which means A, my underwriting was on point, and B, I was finding properties that, experienced operators wanted. So I said, okay, I think we've got enough of a test case. Let's start putting, our own capital into the market. So 2018, I bought my first self-storage facility, started small. So 17,000 square feet was $1 million facility. And then slowly started increasing the size of our buy box so that we can start buying more institutional grade or building institutional grade assets. So these are going to be things that are 65,000 to 100,000 net rentable square feet, 2, 3, 4-story buildings, state-of-the-art technology, state-of-the-art security. Now, instead of buying them for $1 million, we're building them for $16 million and then selling them for $20, $22, $25 million. So that's kind of been the progression on the purchase side. And then the progression from the capital raising side is, you start with your family, basically, people that know, like, and trust you. And then you go to friends, and then you start going to friends of friends, friends of family. And then very quickly you realize that you run out of capital. You've tapped out your entire network. And then you need to start going to people that don't know you. So how do you do that? You got to build up a track record. You got to be professional. You got to have very good investor relations. And you got to put yourself out there like this podcast, right?
Exactly.
And then you start raising from retail investors. And these are going to be your high net worth individuals. These are going to be your accredited investors, right? They make over $1 million net worth, not including their house, or their income is $200,000 to $300,000 for the last 2 years, depending on if they're single or married. From there, you could stay right there. That's kind of where we've been parked for a long time, because it's really great people, very flexible in how you do terms. But eventually you start getting the big boys coming and knocking, saying, hey, we would like some of these returns as well. But our minimum check size is 10 million or 20 million. And you're saying, well, I could build a whole self-storage facility for 16 and I'm going to put 70% leverage on that. So how am I going to put your 20 to work? And that's when you start going into the fund route and you start dealing with more of these institutional investors, pension funds, family office, et cetera. So right now we're right on the cusp of, we have a little over 800 retail investors. And now we're starting to get, some family offices that are coming in and trickling in checks as well.
I love that. Now, tell me a little bit, and I want to dive into a couple of these topics. So, I am always interested to hear how people find some of these off-market deals. So, when you were going out and you were doing some wholesaling and identifying these, operations, underwriting them, was there a particular market you were looking at first, or what were some of your tactics that you went into to kind of, get those deals under contract?
Yeah. So, this question could be answered in a multitude of ways, but let's restrict it down to, let's say you're starting out and you don't have a very large marketing budget. So let's say you want to do your first self-storage wholesale deal or your first self-storage deal. One of the best things that you can do that has a very high return, very low cost, is driving for dollars. What people don't realize is there's not a lot of self-storage facilities in the United States. There's only about 50 to 70,000 facilities, depending on who you talk to. If you're a single family home investor, there's that many in one town, So I was marketing to the lower 48 states. And what I found out was all of the properties that I would go by data lists. Okay. And on those data lists, I knew that there was 50 to 70,000 self-storage facilities in the United States, but all these data lists would always cap out at like 38,000, maybe 40,000. So I'm saying, where are the other 30,000 facilities? How come they're not on any data aggregators list at all? Those are the facilities that typically they don't have a web presence, right? So there's dollars right there that you can value add. They don't have their land classification or land use classification codes are wrong. So they don't show up on a self-storage data pool. Maybe they're considered farmland or small bay industrial, et cetera. So they're miscategorized. That means that they're not getting, the 50 letters that every other person on that list are getting every month from people like me. So the best thing you can do is drive for dollars. You're just driving around your own town, or let's say you're going on a road trip where you're driving from Chicago to Indianapolis or Indianapolis to St. Louis. Along that path, you're going to see a lot of self-storage facilities that, they have a phone number on a sign. The phone number doesn't even have an area code on it. You can't find them on the internet. You go look on Google Maps to see if it has a name. Turns out they're not even on Google Maps. Those are the deals that you walk in. The owner is probably sitting behind the desk and he's probably ready to retire. Those are really great deals because those types of deals typically, they're not raising rents on their tenants. The owners have become friends with their tenants. So, they're not raising rates to keep up with inflation or to keep up with the competition in the area. Their expenses may be, much higher because they've used the same insurance guy for the last 20 years. He goes, they go to coffee every week together. So there's no shopping around. So those are very easy to lower expenses, raise revenue, create a web presence. Nowadays, over 40% of self-storage tenants come from it. The very first thing they do is they Google search self-storage in X city. So let's say self-storage in Champaign, Illinois. And if you don't show up on Google, you don't show up on Google Maps, you're never going to capture that 40%. So there's an additional increase. Go those and talk to them and say, hey, how would you like to, sell? I'm an operator myself, or I want to be an operator. Maybe if you can help me carry some financing, that'd be great. I could pay off in a couple years. those are fantastic deals to start off on, especially if it has some type of seller financing. They're very easy to sell to other buyers.
Mm-hmm. I love that. So when you were first looking and you were going through your list and maybe doing some driving for dollars, what market did you first buy in?
My very first deal that I bought to hold was in a suburb of Chicago. It's called Yorkville.
Okay.
I lived in Chicago at the time. It was a maybe hour and a half, 2 hour drive out of the city. And we found it, believe it or not, by calling all of the self-storage brokers we knew in the Chicago metropolitan area and saying, hey, if you get anything that has hair on it that the big boys don't want, it's going to really take a lot of elbow grease, give us a call. And we had a broker that gave us a call and said, listen, this is off market right now. The seller wants me to list it. If you can come in and make me an offer at, $970,000 on Tuesday, which we went to go see, and we could sign something before Thursday, I won't list it. And that was our very first deal we bought. It was 16,960 square feet. So just shy of 17,000 net rentable square feet. And we put it under contract for his asking price, 970,000. And that first deal, I just, I said, hey, I don't know how much money we're going to make on this first deal because we got to learn the business. So this is more of us just paying for education, if you will. And if we break even, great. But within 3 years, we sold that same facility for $1.8 million. So we made $800,000 in 3 years. Mm-hmm.
That's amazing. I love that.
Yeah.
Okay, so let's dive deeper into self-storage because I don't know if everybody is all that familiar with all that self-storage has to offer. So give me an idea of, maybe like the average. I know you said that the size is, entry size is maybe like 17 to 20,000 square feet and then, going upwards from there. But tell
Sure.
me who your typical tenants are or clients are for these spaces, what these spaces are utilized for, and maybe what some of those rents are looking like so that people can get an idea as to what they would be evaluating.
Sure. Yeah. So, I always classify self storage into kind of three categories. You have the stuff that's below, call it 15,000 square feet. Those are the facilities that they're not a business in and of themselves. There's typically attached to some other business and someone had additional land. So they put up a couple units, right?
Mhm.
There may be a hardware store with some self storage next to it, or someone that has a small piece of farmland, put some self storage near the road. Those are typically not great to buy or sell. Very small amount of buyers. Typically, debt does not want to get involved on that. So banks don't want to lend on that. And they're so small that the revenue they produce do not allow you to hire people to help you. So it's not a business. You're basically just buying a job because you're going to be the person behind the desk working that facility. And that's fine for your first facility so that you can learn how to operate these things, right? Then you have kind of this next bracket of 15 to 35,000 square feet. These are going to be the facilities that you may be able to hire maybe a part-time manager or a full-time manager that also doubles as a janitor that can do cleaning and cutting off locks, things like that. But typically the revenue that gets produced from anything that's sub 35,000 square feet is not conducive for building a large portfolio, because when you buy self-storage, you always got to be thinking of your exit first. Who am I going to eventually sell this to? If I have to sell this to someone like me, then I'm going to have to give some pretty large discounts on price, maybe some seller financing concessions, versus I'm always thinking I want to sell to the next larger fish up the feeding chain. Someone that's going to have cheaper cost of capital than me, cheaper cost of equity, cheaper cost of debt, so that they can pay more for an asset that is basically an armchair investment. I've already done all the hard work, and now they're going to pay me a premium for that hard work I did. So where we are playing in now is between that 35 to 65,000 square feet range. I call this kind of like sub-institutional range, but one that you can run a business with. So you have enough revenue coming in that you can hire, people to do, cut the grass and sit behind the desk and meet with tenants. You can hire a team. So now it's truly a business at this point, at this size.
Mhm.
And then typically what we do is we buy these assets that are between 35 to 65 to then expand them to be above 65,000 square feet. And anything above 65,000 is typically considered an institutional asset that someone on the top 100 operators list is willing to buy, including myself. So what does the tenant base look like? The tenant base is typically going to be, 60% to 70% is going to be what we call residential tenants. These are people that are just like storing extra stuff from their house, or they're moving, or their, parents just went into assisted living facility and they don't have the heart to, downsize from their 5-bedroom ranch into their, 1-bedroom townhome at the assisted living facility. So they just put everything in storage to not have to emotionally deal with it. Self-storage is a transition, a business of people in transition. So getting a new job, moving to a new house, selling a house, moving in with somebody, etc. The other kind of 25 to 30% are going to be broken down. The largest portion of that's going to be your commercial tenants. So there's going to be people like we were chatting about before we started recording, someone that runs a small contractor-based business. Maybe they're a woodworker, maybe they're a plumber, they have a pavement business, maybe they have a pool cleaning or mosquito business. That's going to be your type of tenant. So that's going to be maybe like 20 to 25%. And then you'll always have somewhere between 5 to 10% of, typically, depending on where you are, you're a Penn State person. So students, not the best type of tenant because they usually only stay for 3 months and then they're gone. Basically over the summer, they don't want to lug everything home. So they put it into a storage facility. And then when they come back to school, they put it into their apartment. And then you have, depending also on where you are, you have, some military tenants as well. Also a very interesting tenant group. They usually stay longer, but they have extra protections against auction if they don't pay, et cetera, because of, if they're deployed, things like that. So that's going to be kind of the rough breakdown. The interesting thing is when you look at the data, let's say the residential tenants that make up 60 to 70%, you think that these are people that live in a studio apartment and they have no space. It's actually not correct. The majority of the tenants that you have are people that have a lot of storage space. They usually have a garage, attic, and basement, but there's somebody that typically accumulates more than they have, space for, or they're in transition. So that's going to be kind of your ideal tenant because they stay long, anywhere between 13 to 22 months, which is a very sizable. I mean, we've had tenants that have been at facilities for 10 plus years, but on average, I'd say, anywhere between, call it like the 13 to 22 month period is your typical length of stay. Okay. Self-storage is a very sticky asset. So you were asking about prices. The prices are not very high, especially when you compare them to, say, an extra bedroom in a house or an apartment. So let's say you get a 10 by 10 unit, so 100 square feet, which is a medium-sized bedroom, let's call it, right? You're going to be paying anywhere between $80 on the low end up to $300 on the high end. Doesn't matter what market you're in. If you're going to go rent an apartment, instead of renting a 2-bedroom, you rent a 3-bedroom, you're getting jumped up $400 to $1,000 for that extra room. If you're going to go buy a house, that extra room may be an extra $50,000, right? So great alternative. And we're starting to see this in the millennial crowd where they're opting for smaller apartments and houses and using a self-storage unit, almost like an external closet that they can just go, get the winter clothes, get the summer clothes, keep their kayak, bike there, etc. Various holiday decorations. So it's been a very interesting trend to watch.
Yeah. No, I love that. And it's so relevant right now too, because I think a lot of people are in transient. They don't like the idea of staying put in the same location. Like we were talking, you're not currently in the US. You have the luxury of, being abroad right now. So, I don't know if maybe you utilize some of your self-storage facilities to kind of keep your stuff and don't have to have an apartment or a house to, keep it there. Like it just makes a lot of sense.
Mm-hmm. Yeah, it's funny. I'm a bad self-storage owner in the fact that I don't have basically any possessions. I'm I'm an extreme minimalist. So almost all of my possessions, excluding obviously the self-storage facilities I own, fit in a backpack and a duffel bag. So I'm pretty lack of material possessions right now.
Well, there's nothing wrong with that. There's nothing wrong with that.
Right.
Okay, so I know that we talked a little bit about the differences between a traditional landlord-tenant law and then
Mhm.
the laws that regulate self-storage.
Correct.
Can you get into a little bit deeper so that people understand, like, obviously if you have an apartment or you have a house or you have, some sort of asset where people are residing in, you have to go
Correct.
through an eviction process. And so every state is going to have a different eviction law process. But when you're dealing with self-storage, because it's not a facility where people are residing, it follows a different law. So why don't you touch a little bit about kind of some of those differences and the
Sure.
nuances when you're dealing specifically with self-storage?
Yeah. So self storage, the state laws are extremely strong for self storage owners. And that is because we operate off of property or lien law, as they call it, versus landlord tenant law. So, what does that mean? When you put your possessions into one of my self storage units, de facto, you are giving me a lien against your possessions. So, just like when you have a plumber go work on your house and you don't pay them, they could put a lien on your house, and anytime that your house is sold, that they have to be paid, or else you don't have clean title. So same thing with us. The only difference is that we can force a sale. So let's compare side to side. Let's say you have a self storage client and you have an apartment where you rent a 2 bedroom to a tenant. They stop paying on the same day. What does that look like? Well, with the tenant that's in the apartment, uh, usually you're going to have to serve notice that they are, non compliant with the rent. Then you're going to have to go to court to get a writ of removal.
Mhm.
That process between them being 30 days late and getting that writ of removal, depending on which city or state you're in, can take as long as 9 months. So places like Minnesota or Minneapolis, San Francisco, New York City, if you don't pay, those tenants can take, they can occupy your unit, which is stealing rent, right? So not only are you not making rent, but you also have the opportunity cost of not being able to charge that rent to someone else. And then when they leave, there is a chance that they cause damage because they are feeling spiteful that you evicted them for not paying the rent, and that can cost an additional, who knows, two to $10,000, $20,000, depending on what they do. And then you're going to have to go in and clean everything, repaint everything. That can cost another, couple months rent. And then you're going to have to typically hire a real estate agent to then list that apartment for rent, and they usually get to keep 1 month's rent for finding a tenant. So now, you're out almost 12 months of rent in either lost rents or actual physical costs you've had to do to get a new tenant in there.
Mhm.
Let's look at self storage. Self storage, they don't pay. They're late. I usually give a 5 to 7 day grace period. If they don't pay by the grace period, I can automatically already uh, put out a notice that you will go to an auction if you do not bring your unit current. The second you stop paying, unlike the tenant that gets to continue living in the house, the second you stop paying, I overlock your unit. So now you have no longer have access to your possessions. And in our facilities, they have keypad entrance and exit. You no longer have access to get into the facility at all. So that mitigates any risk of them doing damage out of spite, right? Or coming in overnight and just moving out with all their stuff and sticking us with the bill. The second thing is we do, depending on which state, you have to follow a certain process to putting the public on notice that this unit is coming up for auction. So that could be anywhere between, let's say, 30 to 60 days from the day of missed payment. So already we're 2 months in as opposed to, say, 9 months. On the day of the auction, so 60, let's say the worst case scenario is 60 days, like in California. On the day of the auction, um, someone comes in, they buy all this person's possessions. They have to give us a deposit that if they don't clean out that unit, we get to keep that deposit. In addition to auctioning off that those possessions, we can charge a lien fee, we can charge a late fee, we can charge a removal fee. All these things are what you can charge is all based inside of the compiled statutes of each state. So by the time we have a new tenant in there, or a new customer in there, the unit is clean. We've recovered all of our lost rents, and no damage has occurred to the unit. So, which would you rather do? Right?
Well, I've had the experience of having to deal with a tenant eviction and exactly what you were talking about. So it's still a little fresh.
I'm
There's
sorry
still
about that.
I know.
Opening
Yeah,
up
I
those
know.
wounds.
It's still an open wound. So I completely understand and agree. Like I had, they didn't pay the rent for over 6 months before they decided to move out. And then by the time they moved out, they had caused so much damage. And then I had to fix all the damage. And at that point, the market had shifted. And, I was kind of left with, do I keep putting money into this to keep it as a rental, or do I just sell and move on and cut my losses? And honestly, I sold and moved on just because I was so tired of dealing with it, and just like the demographics of that market had changed, and so the clientele was just not good. And so with self-storage, I mean, you are seeing kind of like a transient type of crowd, but again, to your point, you are protecting kind of every single asset that you have as the owner of the units.
Right. And then not only that, but we also are not locked into, let's say, long-term contracts. So that allows us to shift with inflation. When we had massive inflation because of the post-COVID spending spree that the government did, people that were locked into 1 or 2 year contracts on the residential side, those landlords were not able to raise the rents. And when they finally did go raise the rents, there was a sticker shock to the tenants, and then they moved out. And now you have vacancy, right? It's even worse on the industrial side, where you have 5 to 10 to 15 year contracts with preset, um, rent raises of 2% a year, et cetera, when we experience 16% in 1 year. The nice thing about self-storage is that we are month-to-month contracts that auto-renew regardless if the tenant signs the agreement or not. Almost all states, if you leave your possessions in the unit after you receive a rent increase or a new contract, even if you didn't sign it, you are basically giving your right that you is the equivalent of signing the contract. So that's one of the nice things about us. We have the kind of like this inflation protection hedge. And self-storage is also a recession resilience. So like you said, the market changed on you on that one residential property you had.
Mm-hmm.
Self-storage typically, it does well when times are good because people are buying more things that they don't need. They got, you're getting 3 Amazon packages showing up to your house a day. And then all of a sudden you realize you don't have room for things. So you put them in storage. But when, the economy's not doing good, when you're going into a recession, then you have people downsizing and they don't want to get rid of all the furniture that they spend a lot of money on. So they go put that into storage, or maybe somebody moves in with a friend, or you get laid off. You have to go find another job across town and you need a new apartment that's closer to your job so that you're not commuting 2 hours each way every day. And those people are going to use self-storage as well. And it's a lot easier to pay a $180 a month rent on a self-storage facility than it is to pay a $2,600 a month rent on a apartment. So, most people, they want to pay things in one go. So usually when someone's having trouble paying rent, it's not, oh, I'm going to pay 400 of the 26 right now, and then, another 400. Usually I'm just not going to pay it, and I'm going to hold that cash for other things that I can pay, in one swipe.
Yeah.
So that's one of the things that we like.
Love that. Okay, so now you've talked about you are now developing your own self-storage facilities, and
Correct.
these are multi-level, very, high-end, class A, all these things. So when you're looking to identify a particular plot of land, are there any sort of aspects or indications that suggest that that particular plot of land or location and proximity is good, or what sort of other things do you
Yeah.
look at before you've identified a site to potentially build on?
Yeah. So I think it'd be good if I back up and talk about our 3 strategies. So
Perfect. Let's do it.
one leg of the stool is your ground up developments. The reason we do these is because they are, large facilities all in one location that, institutional publicly traded companies like to buy, and publicly traded companies have very cheap cost of capital.
Mhm.
Um, the reason we started doing that is because our first leg of the stool is our portfolio strategy, where we'll buy kind of mom and pop operated facilities, get them up to 65,000 square feet, put them into a portfolio of 10 to 20 properties, and sell those all off at once. Those portfolios are great, but the problem is, you have 10 35,000 square foot facilities, as
Mhm.
opposed to me just having, let's say, 300,000 square foot facilities. And then the last leg, which was more, more lucrative right after COVID, was us turning big box retail that went dormant, like Sears buildings, Kmart's, Walmart's, into self storage because of everyone shopping online. No one can go out and spend money. So the reason we started doing that is we realized that self storage, it doesn't really matter what type of self storage. You're always looking for the same type of demographics, right? You want high median incomes, so people have disposable cash to spend on self storage instead of just worrying about basic necessities. You want it to be highly visible, because even in today's digital age, where 40% of your self storage customers come from a Google search, you still have another 60% that come from line of sight, where they're driving between work and home every day. They never notice any self storage, but then the day they need it, then they realize, oh wait, there's one on the way between my house and work that I can just stop there on the way, drop things off, or what have you. So visibility. So we want curb cuts, vehicles at, 25,000 plus cars per day would be ideal. On the median incomes, we'll go as low as 60,000, but ideally, if I'm going to be building something from the ground up, I'd like $100,000 median income or better. And then I want dense residential surrounding it, right? I want people that have a lack of space, uh, that need more space. So apartment complexes, single home, subdivisions that were all built by one cookie cutter developer. So all the houses had to be done, at a on budget. So they usually will reduce the amount of storage, because storage doesn't sell. You don't get extra dollars for having more storage in a house. You typically get extra dollars for having more, livable square footage, or bedrooms, etc.
Right.
So those main three things are what we're always looking for. And then another, thing that we like to see is at least 25% of the households are rental households.
Mm.
So if we're in a neighborhood that has, call it 10,000 houses, I want to see at least that 2,500 of those houses are rental houses, and not it's a 100% homeowner, because, renters are typically more transient than homeowners. So they're going to be using self storage much more often. And typically, when you have a tenant stay at a location for 1 to 2 years, they're already so far behind on that inflation increase in rents, that once they finally get hit with the increase, they say, I can't afford an extra $200 a month or $300 a month in rent. I'm just going to move out and go to another apartment that is within my budget. So those are kind of like the four main things that we're always looking for.
Got it. Is there a minimum lot size that you typically are looking at, or is there a particular zoning that you found to be pretty applicable across markets?
Yeah, great questions. So there's the easy way and there's the hard way, right? Um,
Mhm.
so the hard way, which is the more profitable way, is to go into areas that are not zoned for self storage. It does not have zoning as of right, because that creates a barrier to entry for other competitors to come and put up self storage, right? So if I found a hole in a market, and our self storage markets are very small. It's a hyper localized asset. So typically, 70+% of your customers are going to come within a 10-minute drive time, or 1 to 3 miles from the facility itself. So you can say you can't have these like blanket statements like you can with, let's say, apartment buildings, where you're like, oh, Phoenix is saturated. Can't say that. Or Chicago is saturated. What you say is okay is this portion of Logan Square saturated? Is this portion of, Lincoln Park saturated? Because our trade areas are so small.
Mhm.
So if I find a hole in one of these trade areas where there's no zoning available for self storage, then I'm going to go try and rezone. That's the hard way to do it. That's going to take 1 to 3 years to do. But then once I have a facility that's up and running, now I'm a prime candidate to sell that asset at a premium to one of the publicly traded companies. Lot size, ideally, I can get tight. It just the smaller the lot, the higher you have to go, and the higher you go, then you start exponentially increasing your cost of steel, your cost of concrete, and those are things that are very susceptible to things like tariffs, like we're seeing right now, which can cause a lot of problems. So, minimum lot size, I want to see 4 acres. Because if I'm going to go through the effort of building, I want to build something that's institutional quality and size, which
Mhm.
means if I'm building class A, I know my minimum threshold is 65,000, but ideally if I'm building a class A building, I want to hit the ground running with 85,000 square feet, 80 to 85,000 square feet, up to 100,000 square feet of net rentable space. So 4 acres, I can get that space with 3 stories. Once you go above 3 stories, then your fire suppression systems cost more, elevators cost more, so the whole 9 yards. If it's an ideal world, in that lot, I'm trying to buy that lot for less than $500,000, which is a tall order, that whole lot.
Yeah.
But if you can find it, you produce a lot of protective equity for your investors. In an ideal world, I would like to have 10 acres in the same type of demand market for $500,000, because then I can build all single story climate control. Maybe I even offer some drive up units that are climate control themselves, which make it easier for the customers. And my build cost all of a sudden goes from $125 a foot down to like $90 a foot or $85 a foot, all in, right, including the land package. And they're much easier to build. You can work on them simultaneously, as opposed to like when you're building a building from the ground up, you have to start from the ground and go up. As opposed to
Mhm.
if I have a 10-acre lot, I can be building 5 different buildings at the same time because they're all single story. So
Right.
that would be the ideal situation, is a 10-acre lot. I could put up easily, 100,000 square feet. I can even phase them in if I want. So then I could bring in less investors on the front end. I can get the first, loan from the bank. And then once that gets up to full occupancy, I can use the equity that was created to go back to the bank and say, hey, Mr. Bank, you gave me $1 million for the first phase or $2 million for the first phase. This second phase, here's all the equity. I don't need to bring any additional investors in. And all of a sudden now the return to my investors pop up because I was just able to build double or triple the size of the facility using the same amount of equity, as opposed to having to raise all the equity up front for a multi-story facility.
Right. No, that makes a lot of sense. Now, speaking of investors, I want to kind of dive into the investors that you have. And
Sure.
something that you had mentioned to me before we started recording was that you have a strong passion on educating people on being passive and how passive investments are actually more lucrative than if you were, say, the GP or general partner. Basically formulating the plans and making everything happen. So give me a little bit of rundown on maybe some of the historic returns that your investors have had, and maybe, the type of investor that you're looking for future deals.
Yeah, a lot of stuff to unpack there. So I'll just go off of the easy
I know.
stuff first.
I just
No,
like, hand it
I'm,
all
ta-
over.
I'm
So there you
I'm
go.
taking notes, so we're good to go.
Good.
So first thing to touch on is, there's projected returns versus actual returns. So
Mhm.
typically my projected returns are within the market. Typically for alternative assets like real estate, you're looking anywhere between 18 to 25% internal rate of return, double your money every 5 years type of, that's kind of where the market is. So that's what we project. Now, what our actual returns have been over our last 20 open and closed deals have been in between the 50 to 130% internal rate of return rate. And the
Wow.
reason for that is we always set up our deals as a 5-year term, but I've never held an asset for 5 years. An internal rate of return is just a cash on cash return calculation mixed inside of a net present value. So it takes basically what IRR says is if I give you $1 today, that dollar is more valuable than the dollar I give you a year from now. So I'm going to discount the return if most of my return comes in the future, right? So a lot of our deals we set up as 5-year deals, but the shortest I've ever done an entire strategy, open and closed a syndication, was 13 months. So my investors made 133% internal rate of return on that deal, 2.3 times their money in 13 months. And then the longest I've ever held an asset was 4 years and 2 months. So just, 10 months shy of where our projected sale date was going to be. But we ended up selling that asset for much more than we had projected. So that return was close to 56% internal rate of return. So that's kind of our range right now is between like 50 to 150. But, you also got to realize that I started investing in 2016 when the Fed funds rate was 0% or 0 to 0.25%. So when debt is cheap and you can get high leverage, you require less equity for an investment, which causes those individual equity investors to make a much higher return on their individual. Now, back in those days, I was getting 80% leverage at 4% interest, 36 months interest only. Now I'm getting, 65 to 70% leverage at 7 to 8%, so double the interest rate, and maybe only getting 24 months interest only. So that will affect the return. So that's why I always say there's what we project. We've always beat projections. And there's what we've actually got. And I'm always afraid to tell people what we've actually got, because then they assume that that's what it's always going to be. And that's not, past performance is not indicative of future performance, especially when the market is changing so rapidly on you.
Yeah, absolutely.
So that's the typical returns that we're typically seeing and the timelines for those returns. The second question you had was regarding LP investors over GP, so limited partners or silent investors, as opposed to general partners or the syndicators that are actually doing all the work. So GP investments, from a percentage return standpoint, they're typically making more than a limited partner, because they're taking all the risk. They're the general partner, which means they have general liability. They have to wake up every day. They have to deal with all the problems. They have to sign on the debt. So if something goes wrong, they take my house, they take my car, not your house. As a limited partner, not only are you not working every day, so now you're getting mailbox money, you're making money while you sleep. So from a time value standpoint, your return per hour is infinite, because you're not basically doing any return or any work. And then you also have limited liability. So let's say the project goes completely awry. Let's say for whatever reason, a hurricane hits Chicago, which 0% chance or less, it's non-zero, but close to 0% chance, but it could happen. If that were to happen, you are only limited to lose your investment. So let's say you put in $50,000, you lost $50,000, as opposed to the general partner who puts in, let's say, $50,000, but now is on the hook for a $10 million loan, has to file for a foreclosure, file for bankruptcy, et cetera. It can completely ruin them. So way more risk. That's why I am a GP, but as I'm making money as a general partner, I am funneling that money as an LP into other syndicators, because eventually I would like to be at the point where I make money only when I sleep, right? I don't have to do any work, but that's a long time coming from now. I love what I do. I enjoy what I do. I have a lot of energy for it. So that's one of the reasons why becoming a limited partner is much better than becoming a general partner. And then that frees up your time to make other income in other ways. You can be a professor, you can, be an engineer, you can be a tech guy, and you can do that as your 9 to 5, but know that while you're working and sleeping, someone else is making you money.
Yeah. Now, did you say you also had a comparison of your performance versus the S&P 500 performance? Because I think that that's a really big thing to understand, especially with people who, are high income earners, that they are traditionally taught, you go and you get a 401k, you put money away in retirement, and then, at the age of 59 and a half or whatever plus, you're going to have that asset to then dip into. So what are your takes on investing in the S&P versus investing specifically in something like self-storage?
Yeah, so this is a very timely question, because as we've seen over February, March, and now going almost into April, that the S&P had a massive pullback, right? But let's not look at that. Let's just compare the S&P 500 versus other asset classes from 1994 to 2021. So it removes the 91 crash, and then it also removes what's happening right now, but includes some of the, COVID, beginning of COVID, great financial crisis, .coms. So the S&P over that time period from 94 to to 2021 returned roughly 10.8%. So let's say you're an investor that had $100,000 in 1994 and you reinvest your dividends. That 100,000 in the S&P would be worth roughly $1.6 million at the end of that study period. If you took that same $100,000 and put it into self-storage over that period, self-storage returned on average an annual return of 18.8%. So that $100,000 with dividends and returns reinvested would come out to roughly $10.5 million. So the same 100,000 between 1.6 million to 10.5. Which would you rather get, right?
Yeah. And this is
Now,
what time period again? This was from when to when?
1994 to 2021. And this is, I use two data sources for this. It was the National Association of REITs and Y charts. So very, very good data for both of these.
Mhm.
So that, again, self-storage is the best thing to do is always have a diversified portfolio. So if you have 100% of your wealth in the S&P 500, you're not only losing out on return, but you also have significant risk. Same thing with self-storage. You shouldn't have 100% of your net worth in self-storage. But I like to tell people, 10% of investable cash put into alternative assets, because, if 10% of your money, let's say you had $1 million to invest, if you put that 100,000, that 110% made you 10 million, and then the other 900,000 that you put in there made, a 10% return in the S&P. That's, both of them are basically 50% of your portfolio, even though 150%, one half of your portfolio came from a 10% investment as opposed to a 90% investment on the other side. So risk return. During that time, residential returned 14.4%. So 100,000 would have been roughly 3.7 million. Industrial 15.8%. So 100,000 would have been about 5.2 million roughly. So you can see how, there's that calculation. What is it? 72 divided by your interest rate will tell you how many years it takes to double. So this is a perfect example of that right there.
Yeah, no, that's great. So the other thing that I wanted to touch on is your fund. And so the fund that you have created and some of your future deals. What type of investors are you looking for? Do you have specific criterias, and how could people reach out to you if they wanted to be on your LP team?
Yeah. So yeah, we are launching our first fund. Up until this point, every one of our assets have been single asset syndications. But now that we've got, over 50 deals under our belt, I think it's time. Plus, we're getting a lot of requests from these, larger check writers that want to write a 5, 10, or $15 million check. You don't need to be able to write that check to join the fund. We are typically, the fund will be a accredited investor only fund. So you do need to be accredited, which means that your net worth, excluding your primary residence, is 1 million. And, or if you're single, you've made $200,000 for the last 2 years. If you're married, $300,000 for the last 2 years. That being said, we still do have single asset syndications that we do every once in a while for friends and family, where it's a 506B syndication that allows us to take up to 35 non-accredited but sophisticated investors. So you have to have some sophistication around real estate, around investing, etc. If you'd like to find out about us or join our investor team, we have over 800 investors now that have trusted us with their money. There's two ways. The more passive way to reach out is you go to our website, which is SSSE.com. Or if you're more of an active, speed of implementation type of guy like me or gal, feel free to shoot me a call or a text message on my cell phone. My phone is area code 630-408-8090. That is my real phone number. If you text or call me, I will answer, I promise.
That's great. I hate when people give out fake numbers. Okay, Fernando, this has been so great. I really appreciate all of your insights. And one thing that I do like to ask my guests is, do you have any specific book recommendations or resource recommendations that our listeners can look into and, maybe help them either with self-storage specifically or real estate or just, mindset, whatever?
I have so many. So I'm looking at my Audible right now. I have 256 titles in there.
Yep, yours looks like mine.
Yeah. So I love reading about mindset, business, negotiation, real estate. It depends on where you are. If you are going to research more about being a passive investor, I would look at books around syndications for limited partners. There's a ton out there. I don't have any specifically in front of me right now. If you're looking to start a business, some of the best books I recommend is Traction by Gino Wickman. Absolutely fantastic. It's how we run all of our companies now, is using that framework.
Mhm.
You can also read The E-Myth by Michael Gerber, which is kind of like the same thing, but a much more, 30,000 foot view as opposed to like, here's what you got to do on your weekly meetings, etc. Mindset. There's so many great books. One that I recently finished that I love, right now we live in a period of time where the media cycle is just constantly trying to scare us to get views all the time. So we think that the world is horrible, and really it's not. We're living in the best time that has ever existed in the history of humans. And that one is called Enlightenment Now. Very great book. It is
Okay.
by Steven Pinker. I recommend it. It'll make you see how wonderful the world is that we're living in right now. So just to kind of fight that negativity that we're constantly seeing on the news, giving us anxiety, etc. And then if you want to learn more about like macroeconomics, especially on a global scale, to kind of help you figure out what asset classes to invest in, I'd really recommend Changing World Order by Ray Dalio. Very fantastic. And then a counterpoint to his book, there is a book by Peter Zahan called The End of the World is Just Beginning. Those have been the most recent recommendations I've been giving to a lot of my friends.
The end of the world is just beginning.
Yeah. So the Ray Dalio book, Changing World Order, is talking about how China is going to overtake the United States as the reserve currency and reserve superpower. Ray Dalio or Peter Zahan's book, The End of the World is Just Beginning, is the counterpoint to that, showing how because in the United States, our geographical location, the fact that we control, we're on a basically very hard to invade continent. We have all of the resources we need either with us or at our two trading partners, which I'm hoping will stay our trading partners. That the United States is really poised well for this decoupling or this deglobalization that we're now starting to see, kind of this protectionist policies that we're seeing from a lot of countries around the world. So very good counterpoint. I always like reading both sides of, an argument to kind of, so
Mhm.
those two books you have to read together.
Got it. Makes total sense. Well, Fernando, thank you again. I will make sure that all of your contact information is included in the show notes. And any last words of advice you'd like to leave our audience with?
Speed of implementation, it's not going to happen tomorrow. Do it right now.
Love it. Love it. All right. That ends another episode of Inspire Wealth. I am Prof M, out. And for those who want a more hands-on learning experience, check out our online courses at inspirewealtheducation.com. Whether you're just starting out or looking to expand your investment portfolio, I've created step-by-step guides and resources to help you achieve your financial goals. So hit that subscribe button and let's start building your wealth one episode at a time.